Hello friends, a very good day to all of you and hope you are all doing fine. Over the next few minutes, we discuss some of the key events of the recent past related to the Indian equity market and also present our views on the market outlook. The Indian equity market movement during the past month continued on its uptrend that started in June, primarily on the back of foreign flows which picked up pace during the month. The Nifty 50 index went up by about 3.5%, while mid-cap and small-cap segments fared even better with 6.2% and 4.9% gains during the previous month. While the macro concerns on elevated levels of inflation across the globe and consequent interest rate hikes and their impact on economic growth continue, the surge in foreign flows have resulted in Indian equities moving up during the quarter. On the global front, most of the economies are reeling under the pressure of high inflation rates and subsequent interest rate actions, leading to weak consumer demand and significant slowdown in economic growth rates. In this global backdrop, Indian economy looks far more resilient. The latest GDP figure for the first quarter of this financial year has come at 13.5%. While this is lower than expectations and seems to have seen more than usual sequential dip as well, it still is one of the best growth rates in the world and is expected to remain relatively stronger as compared to the global growth rates. Even on the inflation front, India seems to be in a relatively better position as compared to the developed world, where food inflation is expected to remain high, not only due to continuing conflict between Russia and Ukraine, but also because of severe weather conditions across many of those regions. Monsoon progress has been steady for India, and also high levels of food grain stocks and reservoir levels provide additional comfort that food grains availability and production will be robust. Another heartening factor for India has been the strength in credit growth in recent times. The latest year-on-year credit growth number was over 15%. In the current financial year, the overall credit growth has remained consistently in double digits on a year-on-year basis. On the earnings front, we have seen small downgrades in financial year 23 expectations post the recent quarterly season. Overall, we believe in the near term we will continue to witness margin impact and or inventory losses for most Indian corporates. We may see things improving in the second half depending on inflation trajectory. As far as our portfolios are concerned, we continue to focus on economic recovery plays and consistent compounders that have room for higher than average market earnings growth as well as possible valuation re-rating. The sectors or segments such as large banks, industrials, auto, cement and chemicals continue to have overweight exposure across most of our portfolios. On the valuation front, currently Indian equities seem to be trading above fair value zone once again after the recent up move. While we remain positive on Indian equities, we also recognize that the current valuation levels do not leave much room for any negative developments or disappointments. The delivery of earnings on expected lines will be crucial for sustenance of current levels, more so for mid and small caps. As far as how to go about investing in equities now, we believe that one needs to follow time-tested principles of regular investing and long-term focus. The recent sharp pullback in markets, largely unexpected after 3 quarters of bearish or lull period, also once again underlines how difficult it is to time the markets. With expectations of continued volatility in the short term, we advise equity investors to make disciplined and regular investments with long-term focus and utilize periods of volatility to build on long-term portfolio at better valuations. We continue to be positive on corporate earnings cycle over the next few years, despite fears of disappointments in the immediate term. We advise investors to have a slight tilt towards large caps and look at mid and small cap strategies only from an overall cycle perspective and have an investment horizon of at least 3 to 5 years. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.